So who qualifies for a reverse mortgage? Like any other mortgage, there are a lot of requirements that we deal with, but the three primary requirements we have are: number one, at least one homeowner must be 62 or older. Now this is a big change from the old reverse mortgage program. In the old days, anyone that was on the mortgage had to be 62 or older. But you can see how this caused a lot of problems, because if he was 62 and she was only 61 when they did the mortgage, he was the only one on the mortgage. Fast forward 20 or 25 years, if he was to pass away first, this could leave her in a very difficult situation. Having used most of their equity by that point, she may not be able to refinance or sell the home and have enough money to buy a new home. And so with the changes that have been made in recent years, the requirement was changed to be only one homeowner has to be 62 or older. If the couple is married, then the spouse must be on the loan. Whether the spouse is 18 or 58, that spouse must be on the loan. And the nice thing about this is this protects both homeowners for the rest of their lives. As long as one of them is living in this home for the rest of their lives, they're going to be protected by the reverse mortgage program. The second requirement is that the home must be your primary residence. This simply means that you live in this home for at least 6 months and 1 day out of the year. What you do with the rest of the year is, of course, your business. And so if you have another home in a more suitable climate, or if you like to do a lot of traveling, that's all great. As long as you say that this is my home base, this is where I get my mail, then we're fine. We meet that requirement. The third requirement we have is the equity reserve. Now, I explained earlier that with the reverse mortgage, the interest is being added to your loan. And so over time, your balance is going to grow. Now, we want to protect your home from going upside down. In the old days, this wasn't the case. Most reverse mortgages were designed to use all of the equity left in the home. And so if you lived to be 80, 85, or 90, there was a high likelihood that you probably didn't have any equity left over with that old reverse mortgage version. The new reverse mortgage version wants to protect that equity. We want to make sure that your home doesn't go upside down, or at least we protect it from going upside down for as long as possible. And so with the new reverse mortgage program, we're setting aside enough equity up front, and we're charging a lower interest rate so that your home's equity will go further. Now, I must disclose here that the equity in your home is dependent upon the market. And so it doesn't matter if you have a conventional mortgage or a reverse mortgage. If the housing values fluctuate, your equity is going to fluctuate with it. But by and large, we're trying to extend your home's equity for as long as possible to secure your future and the future of your home's value. Let's use an example so you can see what I'm talking about with this equity reserve. Imagine we have a homeowner named Bob. Bob owns a $400,000 home, and at Bob's age, we need roughly about 50% of his equity as an equity reserve. And so we take his $400,000 home. We take $200,000 of that equity and we just leave it alone. He's not forfeiting this money, he's not giving it away to the bank. We're just saying we're not going to touch this. The other $200,000 is what Bob can use. Now, this is used to either pay off his existing mortgage, it's used to consolidate debts, to vacation, or if he doesn't need that money right now, we just leave it in a line of credit and he can access it further into the future.